Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to episode 144 of the AJ Brown Show. My name is Cyprian Francis, and looking dapper this morning, Mr. AJ Brown. How are you doing, sir?
I'm doing well. I mean, look at the market. I'm both excited that what I've been saying for all these months is happening, and also a little bit fearful because what I have been saying all these months is happening.
Yeah, and that's the pullback in the market. Now, my initial question to that is why? Well, I mean, is it the earnings? Because we're having a good amount of earnings come out, and there seem to be some chatter there that's driving things.
Yeah, it's earnings. So it's this ongoing story of maybe the plays that we've been making for the last quarter into these high flying tech stocks that are powering the AI movement. They're not going to be that instant turnaround and get rich quick scheme that people are attracted to. And so that right there, the story of AI taking longer and being more expensive than investors wanted is one aspect. But then what's been creeping up this week is, could the Fed be too late to the game? Could we be in for a hard landing? And it's one of those chicken and egg things. When you start having those sorts of rumors go out in the market, it causes people to sell, which then increases the rumors, and it starts to snowball. And that's what we're seeing right here. We had our Fed press conference on Wednesday where Jerome Powell hinted at some things, and then we had our employment numbers today. We had some news from the manufacturers on Thursday. When we get into it and start to unfold it, people will start to see why these fears are jumping into the market.
Well, where do you want to begin? Do you want to begin at the beginning of the week where we had some of the consumer confidence numbers,
Yeah,
and then just maybe your feedback on the Fed? Because I know they give their statement, they make their change, and then there's the Q&A. So let's go ahead and pull up your data. I believe you got it on your end.
Well, we started off like the confidence, right? Consumer confidence. So Monday and Tuesday were blah, blah days. Nothing really happened. Consumer confidence came in. It actually came in a little bit on stronger than expected. It's at that kind of break-even point where it's not changing. So, people were undecided as of Tuesday, and you could kind of see that in the market. I'm going to go back and forth. So if I zoom into a 3-month chart, you'll really see it clearly. Here's Monday, here's Tuesday, right? Kind of no-brainers. In fact, kind of a layover from Friday of the previous week, just kind of sideways motion. And then, on Wednesday, you started to hear from the Fed, right? And what Jerome Powell said is, hey, we're not going to do any policy change with respect to interest rates. Now, he didn't talk about quantitative tightening. And I think I might have mentioned this in some prior weeks, but it's worth talking about in a quick second. But what he did say is that a rate drop in September is probably more likely. Still data driven. He's still going to, put a whole bunch of like contingencies in there, but he was hinting at it being more possible in September. And then he also said that the dual mandate is starting to be contentious, meaning that, the Fed, and this is the only central bank in the world that has this dual mandate. Most central banks, their whole purpose in life is to control inflation. But the U.S. Fed also has this other mandate, which is to keep U.S. citizens employed, right? They're supposed to make sure that employment stays full as well as inflation stays in control. And a lot of times that doesn't agree with each other. And sometimes it doesn't agree just a little bit. And sometimes it starts to get aggressively where if you do one, you're going to aggravate the other and vice versa. So he said that, hey, it's starting to get more difficult to, hit both goals, and that now employment issues are becoming more of the focus than inflation. For years, we've been talking about inflation, and all of a sudden he brings up in his conversation that he's worried a little bit about employment getting out of control. And then guess what? You come back today to the employment numbers, and the employment numbers are totally plummeting the market today.
And so, looking at your chart, following that Fed meeting, we were optimistic. We were on our way back to these all-time highs. Yesterday's drop, I believe, was earnings driven. I believe, right?
Jobless claims that are reported weekly every Thursday. Jobless claims were quite high reported this Thursday for the prior week. And so people started to say, oh crap, do we think that the employment numbers are going to be bad? Because, the jobless claims are a week behind. And so the employment report for the month, they're saying, oh, uh-oh. And that was right after Jerome the previous evening was like, I'm worried about employment. And
so
then
they're like a month behind of where the data's starting to creep up against where they want it to be.
That's exactly right. And if you take a look, well, and then on top of the employment numbers yesterday, there was also manufacturing, and manufacturing all of a sudden had a huge drop in orders. They had a huge drop in the number of manufacturing jobs that they're holding. They had to let people go. And, things are just slowing down in the manufacturing, and the production is starting to slow down. So that got people a little bit worried. And then take a look at the employment numbers today. First of all, last month we reported 206, which was like, we were all excited about that being such a high number. Well, they came back this month and said, actually, it's 179. So took a little bit of luster off of last month's numbers. But then they said, well, in this month, we expect it to be 180. Came in at 114. So, not necessarily half, but it was pretty close to like 60% of what they expected, that isn't good. And then you look at this unemployment rate, right? They reported 4.1. And if you remember last month, that was kind of a kick up. But then today they reported 4.3. It's going up pretty quick, right? People are out of work. Private payrolls are down. Manufacturing is way down. Participation rate's pretty good. Pay is pretty good, but people are being let go. And that's creating, all of a sudden, this whole thing about, bad news is good news. It flipped as of yesterday to bad news is bad news. Is the Fed not going to be able to control this? Is this no longer going to be a soft landing? Are we in for a hard landing? And that chicken and egg just started in just the last 48 hours. In fact, go.
I was going to say the last 48 hours move is
Holy
rather large
moly.
comparatively to maybe like 2 weeks of moves.
I mean, take a look. We hit this low back on July 25th. And even though we had a sell-off yesterday, we were still closing above that low on July 25th. But, the bear jumps out the window. And today not only did we gap down, but we're definitely creating this Z bar. It's a down bar for sure. And, the scoop is, take a look at the FedWatch tool. So we're up to September. There was no policy change. Look at this. This is a 50 basis point rate drop. And you look at these numbers over here. Yesterday, this was at 22%, and today it's jumped to almost 75%. The market is pricing in a 50 basis point rate drop in September instead of a 25 basis point rate drop.
That's a big jump, right? From last
big jump. And I wouldn't be surprised if this goes back to normal numbers. So 1 week ago, this was at 11.5. 1 month ago, this was at 5.5%. Yesterday, it was at 22%. Today, it's at 75%. So it's kind of maybe an overreaction, but just to show you, all of a sudden the bear can jump out the window overnight. What we were thinking about, last week we were talking about 88% belief that there was going to be a quarter point rate drop. One day ago that was at 78%, and today it's at 26.5%. So this is a quarter point rate drop. Keeping the policy the same isn't even on the map anymore. Quarter point rate drop, half point rate drop, right? So you can see that all of a sudden investors have gotten quite scared, and they're already pricing in some crazy drops. In fact, we jumped to November. This is a half point rate drop. Now we're talking about 3/4 of a point rate drop. So another quarter point, or maybe even a whole point by November, right? Going back down to this 425, 450. We're currently at the 5.25, 5.5 mark. They're thinking, it's kind of 50-50 here. And then you look by December, we're pretty much pricing it. Oh my goodness. All of a sudden, the majority is saying we're going to have by December a 1.25. I think that this, when you see these type of moves in less than 24 hours, you almost think that the needle went too far and it'll start to correct. But, at this point, we're still thinking that there's 2 or 3 rate drops, but instead of being just 0.75 or 75 basis points, a 3/4 point rate drop by the end of the year, some people are even talking about 1.25% drop. So, people are reacting. They're saying, oh my gosh, as usual, the Fed's late to the game. We thought maybe that, it's so easy. It's just like in options trading, right? The minute you have a losing trade, everybody is going to come out of the woodwork and they're going to tell you how crazy you are, right? So they were giving the Fed, they're like, maybe the Fed is coming in for a soft landing. Maybe it's going to be okay. But the minute there's any hint that something's going wrong, they're like, yeah, that Fed effed up.
My question is, we are one of the nations that are late to cutting rates, right? Because didn't Bank of England cut recently, and a few of the other? So does that have any effect on some of this commentary where we're just the last ones to hold out from this big recent global inflation jump?
I mean, it's all part of that building snowballing story. I did want to point out, I kind of hinted at it. You know how we look at that quantitative tightening, which is this other tool? I actually have been noticing that they have been slowing for the last month on the quantitative tightening. You can see how it's kind of flattening out. It used to, about back in May, it was quite aggressive. We were selling those bonds. And Jerome didn't really talk about the quantitative tightening, but I've noticed that the Fed has started to slow in their quantitative tightening. They haven't reached their target yet, but they're kind of slowing. So I think that for the last month, they've kind of known something was amiss, and they've started to pull some of their other levers that they don't talk about very often, to try to keep things going stable without having to talk about it and without having to, touch interest rates. They've been slowing down this bond selling process. So it's kind of neat to look at those things behind the scenes. Since it's all public information, it's just that it's not talked about.
And a half basis point move would be kind of like a little bit more dramatic than what the Fed has done in the past, right? Mm-hmm. Like we could see a big reaction from that.
Mm-hmm. And it may not be positive. You never know, right? Because, the economists actually, I've read quite a few white papers in just the last, 10 days about how rate drops and rate hikes affect the market. And there may not be an actual direct correlation. It may more be, we look to the Fed for guidance, and if they do this action, we adjust our own personal behavior, either consciously or subconsciously. a half point rate drop may not spur that buying. It may actually cause, at least in the short term, more fear, like, oh shit, things are out of control. We better tighten up our purses. And so, usually a rate drop is supposed to get people to open up their purses. But if you see that the Fed is like dropping rates aggressively, that might cause you as a personal person to say, oh gosh, I better wait until things are a little calmer.
I do want to bring up your S&P chart with your fib levels, because I know that's
Oh yeah.
we always do, like, I'm curious to see where we're at now, because we've talked about it so many times and we're finally getting into an area where it actually matters.
Yeah. So, I was wondering as of last week, because we had closed, our lowest close was right on that threshold of our swing trading to sideways channeling kind of differentiation on which way the market would go. And so I was going to be having a hard time, and I've been telling my program participants to kind of stay vigilant and be ready to do either turn to a bias where we look for swing trading opportunities, or we turn to a bias where we really get into our premium selling. In fact, one of my top star students mentioned yesterday, he's like, the market that we've seen in the last couple of months has been difficult for the sideways channel or premium sellers, because it's been, driven kind of this swing trading, but also driven by money that's a little bit more unpredictable than usual that we've seen in the past years. Well, as of today, we're falling into this area. In fact, now my eye is clearly over here at this $5,235.48 level. I'm curious whether or not we're going to wind up getting lower than that, right? That's my 100% retracement. That's where the last kind of move up, we call it range expansion, that last move up started from. And if we go below that level, what that usually means is that the uptrend is over, right? It means that, hey, we're starting to see some downtrend activity. But you know what? We're looking at today, and there's a lot of alarm bells going off. They're saying that the NASDAQ chart is in a correction, which means that indeed the NASDAQ did go below that 100% retracement. The S&P is a little bit cooler, right? Because it's got a lot more in it than just these high-flying tech stocks that have been selling off recently, while people have been moving their money to more defensive plays. The S&P 500 has a lot of those defensive plays in it. So it will be curious to see what happens, but we are definitely clearly, this red territory I have here is clearly telling us that if you're into sideways choppy, which us, premium sellers are, you're going to be having a heyday probably for the foreseeable future, 2024, maybe even into 2025. So we're kind of celebrating a little bit, but I am curious how far we go. And I am, of course, going to be paying attention to, because I know how fast the bear can jump out the window, this other level that I've got identified called 5,133.59. I'm curious if we dip below that, because that would mean a whole different thing. That would, instead of it being just like a bunch of hype like we're seeing right now, that would actually confirm it for me that a hard landing is, I'm not actually concerned about this whole hard landing discussion that I'm seeing all the pundits talk about. But if we do dip below that 5,133.59, then I'm going to be jumping on that boat too.
And we're not too far off, right? We're like 50 S&P points off from that red mark that you showed, and then from there, only another 100 points. And
we're about 70 points off of this, and then from here down to here, it's another 100 points. So if the S&P drops 170 points, I'll be thinking that, it's not just hype. It really is that we're going to be in a temporary sell-off.
And one thing that I'm seeing a lot of is the discrepancies in the indexes, right? Like you mentioned that the Nasdaq's really getting hit hard, but some of the other, and I haven't really seen that type of divergence, but I think it does show that the industries, the money's shifting from a small cap to a mid cap, or from a large cap to a
I
small
mean,
cap.
not
More
only
than
that, did you see the price of gold shooting up? The price of gold is shooting up. So that's always a like the for lack of a better word, the gold standard of knowing whether money is fleeing risk, right? Risk being like the AI plays and stuff like that. The price of gold has shot up. You would think also that the price of oil might shoot up. Oil is an interesting thing, right? So first of all, I don't know if you paid attention in the beginning of the week, but Israel went out and kind of like took care of some of their dirty laundry there and got rid of the heads of both Hamas and Hezbollah, which is creating more unrest when everybody's trying to get that situation in the Middle East to calm down. These guys are taking out leaders of their opposition, and so we saw oil start to spike. Whenever you have skirmishes in the Middle East, we always see oil spike. But this whole story here about, is there going to be a hard landing, already has oil futures going back down, because when things tighten, people stop going on trips. They stop going on road trips. They stop, the price of oil then goes down. So whatever's happening in the Middle East was overshadowed by the fact that people think that people are going to start holding on to the every little penny they've got and not do anything luxury, not do any trips, not do any cruises, not do anything that is fossil fuel intensive.
All right, well, let's go ahead and give everyone a chance to jump into your daily workshop. In our next segment, we're going to talk about how, when the bear is jumping out the window, we can use options to take advantage of that. We can use options to protect our portfolios. We can use options to take advantage of the move directionally. We can use it as protection. And if that's something you in the audience are interested in learning more about, AJ's got a wonderful daily workshop where he breaks down 4 of these strategies. The link to this is in the chat. Head on over there, sign up. In the next segment, we're going to talk about volatility, right? I mean, that is got to be rising, and how can we take advantage of it? How can we make some money? We did so a few weeks ago. Things are starting to get stirred up again. Curious to see if there's a position to play. So we're going to take a break. We'll be back. We'll go over that. We'll go over a couple of the speed round picks, AJ's pick of the week. We've got some user commentary. Sit tight. We'll be back in a jiffy.
You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, volatility. AJ, I know last week or maybe even the week before, we had a couple people asking, "Oh, what's up with this VIX trade? They were it's not moving, it's not going in the direction that we needed to." And I think your response was like, "Hey, just wait. Just, there's something's going to happen. These levels are too low. What are you seeing? Let's go ahead and pull up the chart for us."
Well, here's the VIX, and look at what's happening today. This is just classic, right? When the bear jumps out the window, volatility goes high. I want everybody to remember that this is my line. If I go back in time all the way to the beginning of the VIX, we're talking back in 1985. We're talking about something like 30 plus years ago. Is it 30 or 40? 85, 95, 2005,
39.
39, 40 years ago, right? Roughly. So that's where this dotted line comes. And we call that the mean, right? That's where the average, if I go back a little bit here and I take a look like at 2 years or even 10 years, if I look at 10 years, you can see there's a certain amount of bars that are below the white line, certain amount of bars above the white line. And the key thing is when it goes below, it doesn't go very much below. When it goes above, I mean, sometimes it goes out of the park, right? And you'll notice today's bar is nothing compared to some of the bars over the last 10 years or so, right? This is the pandemic bars. This is, if we go back a little bit further, say about 15 years, I'll do that right now. We should be able to see the, here's the 2000. I didn't even get back far enough. Let me do 20 years. I'm trying to get back to the, yep. This is the global recession, right? And so you can see that throughout that time, we've had some amounts of fear, right? Whenever the VIX goes up, it means that people are buying options as hedges against, the market breaking down. And so you see these moments where there's this run to options to protect themselves against risk. You can see the pandemic. But when it comes down to selling those options and removing those hedges, removing those insurance policies, we only get to a certain level, right? In other words, people are not ready to just drop insurance altogether, right? There's still a certain amount of baseline amount of fear that is in the market. We only get so confident, but not so confident to stop using the options as hedges whatsoever. So we talk a lot about our trade that we set up kind of as a hedge for our portfolio. We look for these bottom signals, and we talked about getting this bottom signal in about the middle of July. And that's when we put on one of those trades that's two spreads. Here, I'll kind of draw it for you. It's two vertical spreads, a debit spread and a credit spread that offset each other, so that if you stay in this range, right, if you stay in, usually we put it around like $12 to about $18. If you stay in that range, the trade is going to cancel itself out, and it winds up maybe just paying for its commissions. It's a hedge, right? It's a hedge to protect our portfolio. But anytime we have these moments where the fear jumps, remarkably fast, like we are right now, that's when these trades kind of, pay us back. And that makes sense, right? Because when the fear does this and the market becomes kind of out of control and unfavorable, it could be that a lot of our other trades don't work as predicted. And so it's nice to have this trade start to pay back so well, because it could offset other portfolio losses when there's instability. So that particular trade that we've got this round, we did one about 4 months ago that wound up doing really well for us. The next one we did wound up, just being in that break-even zone when it expired. And now this one's looking to do very well for us. But now the question is we've got this spike today. What can we do about this spike today? And so one of the things that I like to do is I like to look back at previous spikes and see, what are they all about? Because one spike is like another spike, and you'll notice the spikes go up. Spikes go up. I'm going to keep going back a little bit here. Let's go over here. The spikes go up, and they usually come down within about a week or two. So you almost wonder, right? We're always taught to buy low, sell high. There's some ETFs that are reverse VIX. That's one opportunity. The other thing you can do is be selling into the VIX. So wondering if we could sell some options or buy some put options against the VIX that will profit on this move down. And the move down tends to not be, I can see some signals here with our traditional signals, but I'll be honest with most of you, our signals tend to be a little bit slow. Our usual signals tend to be a little bit slow for identifying when the fear subsides. So you almost have to use some sort of other indication if you want to trade this directionally with just some put options for this would be like a quick 1 or 2 or maybe 3-day trade of following the VIX until it bottoms out. And I there's a technique that we teach our full-time traders to watch the actual velocity of the price action, right? We actually, watch the movement over time. And if it starts to go like instead of going 10 miles per hour, it goes 50 miles per hour. And we don't actually say miles per hour, we say dollars per hour, right? If it starts to drop at a certain velocity, that's when we pile in with our put options. And that's almost the way we call it equity trader momentum. And that's almost the way that I would recommend we try to trade this drop. And I think that you can make some quick cash, but you're going to have to be in front of your system and watching, because if you miss these marks, even by, a half an hour, you'll probably miss the trade.
And while you're discussing this, we had the scroll bar giving the link to the indicators. There's a nice little green arrow there at the bottom. And so if you have access to AJ's indicator, you would have been right in on this pull up. And so the link to grab that is in the chat. So if you don't have this already installed on your trading system, head on over there, download it, get access to it. It's been evolving. AJ and the team are doing a wonderful job of getting that in a really good place. And it's a great example of it doing its thing. We'll see more of that later on in the show. AJ, before we continue on and dig into your pick of the week and some of the speed round, we did have a question from the audience, and it is kind of in line with what's happening this week, and that's Amazon. I believe they had earnings yesterday. Curious to see where we're at from those earnings.
Yeah, so earnings didn't do so well for Amazon. And Amazon tends to, if you look back at previous earnings, there's a little bit of, Amazon is one of those companies, Jeff Bezos and all of the escapades there, that is a little bit more front and center in the news. It's a tried and true company, right? It totally makes earnings. It's doing things that companies have never done before with efficiencies. But yeah, they were off this past week, which again adds to the whole story that people aren't buying as much as they were before. And investors kind of hit it in the teeth. But look at this bar. So this bar that we see today, after the sell-off, after the huge, sell-off pre-session and after hours, after the earnings call, I'm going to actually zoom in on this bar let's make it into a 15-minute bar instead of it being a daily bar, because I want to dissect this a little bit. So, all right, and then we'll take a look right here. So you'll notice that during amateur hour, there was some sell-off, but now that it's the morning session, we've actually retraced. When you look at the daily bar, a bar that looks like this, you call that upside down Lincoln's hat. And, it looks like Lincoln's stovepipe hat upside down. And what it means, and we're seeing this in the intraday chart, what it means is that the bears were trying to sell off, and then the bulls came back and said, it's not necessary to do that. You're overreacting, right? And even better is a chart where you wind up seeing the bulls come back and not only bring it back to parity, but bring it up even higher. That's sometimes called a key reversal up bar pattern. And it usually means that a bottom has been found. So, this may be a great opportunity for some bargain buying. Now, I personally would want to see a little bit more confirmation on that. I wouldn't want to just jump in, and as a lot of investors say, I wouldn't want to just try to buy this dip. I'd want to see a little bit more confirmation. The volume's there, but the volume could be there by the selling. I'd like to see a few more days of upward motion, like maybe 2 or 3 S bars in a row. And then I might jump in on some directional move on Amazon. Also, it doesn't hurt for me to wait a couple of weeks and determine, let this sideways motion mature and find out where my support and resistance are and turn this into an income trade. Amazon, if you had the money to do it, has been a really good income generating. And when I talk about income, I'm talking about selling premiums cyclically against a covering position and creating that monthly or cyclical incomes, those little paychecks. And so I think that Amazon is just having a step function decrease, and you just have to wait for that new line of support and resistance to start. So In the short term, you might be able to trade a directional play. In the medium term, let's see a channel kind of mature, and then let's start trading premium again as we have been for the last 6 months.
Yeah, I'm personally impressed by Amazon's efficiencies on a day-to-day basis. I mean, sometimes I order things that are here like 6 hours, and I'm like, how's that even possible?
And a lot of people know that I've moved from being closer into Washington, D.C. to being a little bit more out in the suburbs. And still, I'll order something in the morning and it'll be here by 4. It's just amazing to me.
And I don't know if you've seen the drone delivery systems, but they're like evolving where like the drone goes and it drops it in like a net, and it just like goes into wherever it needs to, and that's like another evolution of the efficiencies. It's pretty wild.
I mean, I'm sure you're seeing that. Los Angeles, I'm sure, is like the perfect proving ground for that. That's pretty neat.
Yeah, I had my friends over this week, and they never seen the delivery robot. I don't know if you have either, but it's got like the lights and the food. Just the robot just goes down the sidewalk, and they were like, mesmerized by it because it's like this first level of AI evolution, robotics being into, and it's funny when people are walking, they just step aside and let the robot keep going. It's just like we've accepted these things, and Amazon's definitely on the forefront of that.
They're definitely on the forefront.
So yeah, good long-term name to add to your portfolio and make some premium if you get into some of these strategies that we discuss on the show. All right. The people want to know, what are you looking at this week, AJ? What's the pick of the week? Today it's Behemoth, Verizon, ticker symbol VZ. What are you seeing? What's the play, Verizon?
I know this is going to just frustrate so many people because there's so much movement in the markets. But when there's all this volatility, especially volatility that I didn't know was going to happen as little as 48 hours ago, I go and I look for the consistent, the reliable, what's going to be there, where is money going to be that is not going to be changing, because that's what I trade, right? I'm not somebody who wants to trade, whatever hype is out there. I just want the income to come in, right? So Verizon, boring, right? Has a certain number of fiber optic clients, has a lot of people who are on their wireless service, and they make money. They make money every quarter, and they give a healthy dividend. And people who invest in Verizon are very much interested in that nice hefty dividend. I mean, it's up at 66.5 cents now. That's not bad for a dividend, right? That means that every quarter it's paying close to 2.5% or something like that. So maybe a little bit less than that, but still a nice paycheck for just owning Verizon. Perfect stock for selling premium on. What I'm looking for is a top to form. So I'm looking for a signal. I'm going to get rid of some of my signals on the screen here because it's getting kind of confusing. It's one of the things I was, just on a side note, I was telling some of my program participants just last night was, get rid of the conflicting, indications on your chart, whether it be lines of support and resistance that you decided like 5 months ago when you first looked at this symbol, or conflicting indicators. Stick with what you put in your trade plan. So I'm waiting for a top to form. It's not here yet, so I'm not going to be taking any action today, or maybe not even Monday or Tuesday or next week. But when my little indication says that a top is formed, I'll get a magenta arrow in this case. And I get the subsequent day follow-throughs, right? I program that follow-through into my conditional trading bots. I'm thinking about shorting some Verizon. Either I'm going to short the stock, or I'm going to buy a deep in the money, far out in time put option. The one that I pulled out for myself would be the Verizon March 2025. So that's more than 8 months to expiration, $47 put. So it's very deep in the money put. So I'll either buy that put option or I'll short the stock. And then that sets me up for every time I have a bottom indication, I can sell put premium, buy protective calls, and then just adjust the trade about once or twice every month. Put on the premium trade, put on the protective option trade, and then take them off. Put them on, take them off. And each time I'll make that my own sort of dividend, right? I'll make my own sort of premium trade. And this is going to create a nice, reliable, when all else is going up and down and not traceable, I'm going to be getting a nice, reliable income off of Verizon. And those are the trades I love.
Yeah, and they're not one of these super innovative, wild, flying tech companies.
Right.
And a lot of people need, a lot of businesses, a lot of people need Verizon to
It's
conduct
not going
everyday.
anywhere.
Yeah, it's not one of
going
those
anywhere.
luxury purchases. So Verizon, ticker symbol VZ, we'll keep that on our watch list, and maybe revisit it in a couple weeks to see where we're at.
Not only that,
right.
I wouldn't mind putting shares of Verizon in my long-term portfolio, my real long-term buy and hold, just because of that dividend. So I could see SIP playing both sides of this. I'm talking about setting up a short position at the top, but I could also see the next time I get a bottom signal, setting up a long position and playing both sides and creating double the income and then holding on to the long position and just holding it for years, right? Because like I said, the dividend is too hard to ignore.
Yeah, and that's probably why Verizon sits in a lot of big portfolios, because it can move up and down a little bit, get that dividend. But if you add your premium selling, that's a little extra flavor, a few more percentage points here. And over time, it just accumulates, and it's a beautiful thing that we look at and we see as investors. All right. We've got 3 names from the audience, from the members, from the viewers, and they want your take on it, AJ. So let's dig right into it. This is Rocky from Dallas, Texas, interested in Darling Ingredients, ticker symbol DAR. I believe we looked at this not too long ago.
Yeah, we have. So another company like Verizon, look, they make nice, healthy earnings. In fact, they're paying, they're earning a nice chunk of money. Again, another solid company, not going anywhere, has to happen whether or not the markets are pulling back or going forward. You can see something interesting, though. Last time we looked at this, we had identified a level of support and resistance up here. It looks like we've had what I call a step function decrease, but it's still sideways channeling, right? And again, I'm going to put it out there for those premium sellers. When we're planning out our trade, when we're trying to understand where to put the initial stop loss orders, the bailout orders, right? When we're architecting this really extravagant premium selling setup so that we can set up some income that comes in at every option's expiration, we have to pay attention to where the channel comes. Great. You've planned out the trade, and this channel defines it for the first set of trades that we go, and we've got that plan. But where I find some folks, get stuck is that they'll continue to trust in these lines of support and resistance and not allow the symbol over its life to do these step function increases and decreases, right? And you can trade right through one of these little moves and continue to sell premium on it and allow your protective option to do what it's going to do, and you simply adjust your protective option strike price. You adjust your stop loss order based on where your break even price is and how much profit you want to lock in, how risk free do you want the position to be. But this is one of those cases where I would say this has moved down. I see a top signal forming today. Maybe that's why Rocky brought this to our attention. I see that a lot of the top signals that have formed leading up to today have been, didn't get the follow through and then got canceled out by bottom signals. So I would do the same thing. I would look for my follow through in the subsequent trading days. If I don't get it, don't place the trade. I've seen people who have ignored their follow-through rules and have placed the trade anyway. The reason why you have follow-through rules on the day of trading is to make sure to keep yourself out of trouble. So only trade this if you get the follow-through rules. If you get a signal that reverses this, then just hold tight and wait for a higher high. But yeah, I think that you're onto something with Darling Ingredients. I would look for that confirmed top with follow through, and then yeah, do some shorting of the stock or buy that deep in the money, far out in time put option.
All right, Rocky from Dallas. Thank you for bringing up Darling. Our second name, staying in the state of Texas. This is Lonnie in Austin, Texas. Interested in Cisco, ticker symbol CSCO, another name that we've mentioned on the show a handful of times.
Yeah, look, earnings, dividends. Cisco is one that's in my long-term portfolio. It's the backbone of the internet, right? It's not going to go anywhere. It has a place in our, world. And it's boring. It used to be a high flyer. When I was working at Hewlett Packard in the late 90s, early 2000s, Cisco was like the name along with Nortel, and Cisco wound up with their router technology. They're the ones who persevered, and so now they've got a place as not being a high flying company, but being just a company that makes things happen. It's kind of like a GE, but GE is hundreds of years old, and Cisco is more like 20, 30 years old. With that said, I see a top. I see that we're getting follow through. I'm a little bit nervous about acting on this just because technology stocks, through correlation, there's no getting around from it. Here's what I would do. I would ignore this signal, ignore this follow through, let it bottom out. And when it bottoms out, that's when I think that I would go long on Cisco. I'd buy more shares of Cisco. If you can't afford them, we can look over here at our option chain. We want to go probably 8 months or more out. So I'm looking at the March 2025 option. And I could see probably, let me look at the bid-ask spread. Yeah, I could see really being happy with either this 35 or this 32.50, probably the 35 strike price option. So you buy these things instead of spending about $46.68. I'd spend more like $12.50 for these substitute options. The one thing about owning the stock, though, that I think you might be happy with is that quarterly dividend. So that would be, if you can sell premium against this 3 times in a quarter and get that quarterly dividend and roll out of your protective options, this would be a really good income position. But let's not trade this hype in this pullback right now. Let's instead wait for a bottom to form, and let's go in that direction.
All right, Cisco, ticker symbol CSCO, one of the names that we bring up on the show very frequently. Okay, heading to our third and final pick of the week out on the East Coast. Jill from Hartford, Connecticut is interested in Citigroup, ticker symbol C, one of those financial names that we discussed a handful of times, and it's looking like it's getting hit there pretty hard.
It is. And again, hype, correlation is the reason why, right? The banking industry is going to take, I bet if we pulled up any bank right now, you'd see it gapping down. But I think that fear is overwhelming us this Friday. I think next week we'll see a little bit of a calm return. You might see some people buying on the dip, but I don't think that the selling overall is done. So I would caution anybody from buying on the dip. But I think you're going to see a little bit. You always see that when there's a sell-off like we're seeing today. With that said, Citigroup is another company. It's one of those banks that's too big to fail, so you don't have to worry about that. The government would step in if anything ever happened to Citigroup. I would look for a bottom after this hype, after this insanity today. I would look for a little bit of a bottom and I would see, what kind of opportunities I have. You know what? Now that I'm thinking about it, I would look for the bottom, but I'm conflicted on this one, Lonnie. Not Lonnie, Jill. I'm sorry, Lonnie. You were interested in Cisco. Jill, you're the one interested in Citigroup. I'm a little bit conflicted because Citigroup isn't going anywhere. They make profits no matter what. They give out a pretty nice dividend. So I kind of want to own some Citigroup stock. But at the same time, I think that there's going to be a downward pressure on Citigroup, at least in the short term. So I'm conflicted about telling you whether or not we should buy, look for a buying opportunity or look for a shorting opportunity. And so my answer is maybe we do both, right? Between now and the next quarterly report, maybe we try to do both. We play both sides, and we kind of emphasize this long side as, we don't get too aggressive selling premium. We try to, stack the deck towards not getting exercise, towards getting expiring worthless. We may have to take less premium on this side because I think you want to own some Citigroup for the foreseeable future, especially as interest rates drop and people start borrowing more money at a lower rate. I think that Citigroup is going to benefit on the volume of borrowing, even though they get less spread on the interest rate thing. So I think that you kind of want to own some Citigroup, but at the same time, in the short duration, you might make more money on shorting it.
All right, Citigroup, definitely one that's going to be on the radar of many watch lists, simply because it is one of those too big to fail. So thank you for that, Jill. We did have one quick follow-up question to your Amazon example. I'll go ahead and bring it up here. Can you give me an example of selling put and buying a protective call on the Amazon example?
Oh, sure. And if when it comes to Amazon, in order to sell your put, you would have to have a covering position in place. So when you sell a put, let's go back to the basic definition of what a put option is. A put option gives the person who buys it the right to put their stock to the person who sold them the put option, and in return they get cash, right? So for instance, if I sell a 165 put option to somebody, they have the right to come to me and give me their Amazon stock, and I have to come up with $165 of cash per share. So when you sell a put option, your broker is going to look at your, portfolio and make sure you have a way to buy stock at that strike price. And so they're going to look for cash, or they're going to look for a way that you can get that cash. So for every contract of put options you sell, you need to have $165 or whatever strike price option you sell times 100, right? Because options are sold in lots of 100. So you need to have $16,500 for every contract just sitting in your account in cash, so that you can cover should you ever get exercised, right? And that's what your broker is going to make sure happens. Your broker is going to make sure you can deal with the worst case scenario. Now, you can either have that cash, or another way you can do it is by shorting a stock, right? When you borrow Amazon for your broker and then sell it, like if I borrowed, the next time Amazon's up at like 170, right? And I borrow Amazon stock from my broker and sell it, if I borrow 100 shares and sell it, I'm going to have $17,000 in my account. I'm also going to have a chit with my broker. My broker wants their stock back at certain points. And depending on your arrangement with your broker, they may charge you an interest rate on borrowing that stock. Whatever it is, you're going to have to at some point return that 100 shares of stock. That's what shorting is. But you'll have that cash to cover selling your put option. So a lot of people, when I talk about the initial covering position to sell put options, what I'm talking about, you could short a stock like I just described, or you could have a put option that you bought, right? If I have a put option on Amazon that I bought, and this person that I sell my put option to over here decides to come to me and say, I want to exercise this put option. If I have an equal number of put options that I've bought, I can say, sure. And I'll go over here and exercise those put options, right? And so I can get the cash from exercising those put options like on the fly. That's called a spread, by the way. And whether, depending on whether it's the same expiration date or the same strike price or not, that defines whether you've got a vertical, a horizontal, or a diagonal spread. All to say, you're not going to be able to sell put options right now if you don't have an initial covering position in place. So you would need to have, in the last few days, shorted some Amazon or bought yourself a deep in the money, far out in time put option. And you usually do that when you get these type of moves, tops. When you've got your initial covering position in place, then you can come back over here and sell a put option and buy a protective call. And if you started your trade up here, say for instance at 200 or even down here at 190, when you buy your protective call, you're going to go ahead and buy a call with a strike price up here, right? It's going to hedge your risk. Your risk, if you got into the trade up here, then you don't have any risk. Your trade is in the black until it gets up here. So that's where you buy your protective call. And if you're doing that purchasing of that protective call when the underlying symbol is down here, this is going to be at a bargain basement price. It's going to be really inexpensive to protect your trade. And you're going to get the most money when you simultaneously sell the at the money premium down here. But again, you can't do any of that if you didn't have some forethought to set up the initial covering position. So that's where you're at. I mean, there's other ways to do the Amazon. You could try to do some sort of like a vertical spread, do a half of a condor. But with our traditional ways of selling premium, you would have had to have some thought when you had this top about a month ago to have shorted Amazon or bought that substitute put option so that you could now take advantage of this opportunity now of selling the premium. If you didn't think that through, then you're not set up. There's a lot of planning in these premium trades.
All right. Well, there's a pretty thorough answer to the follow-up question on Amazon. So thank you for that, Mari, and thank you for that, AJ. We're heading into the close of the show here for the day. So topic of the day, topic of the week, volatility. We're seeing a market sell-off. We're seeing a pullback. Is your goal to kind of see where we end the day with all this before you start deciding what you want to do next week?
Yeah, it totally is. But I'm really eyeing SIP. I'm watching even today. I'm already seeing the VIX. Can I just show people? Do I have a minute to show them the 15-minute chart?
Go ahead, pull it up.
So, yeah, already the fear is subsiding. Do you guys see that? So I might try to do, I got some time today after the show. I might be watching this velocity and I might be doing, God forbid, some quick day trading because it's just going to be so lucrative. When, the fear subsides, it tends to subside quite quickly. So, there was a lot of hype this morning on the employment news. It's already starting to settle in and people are starting to pull back. And I think that there's an opportunity, just a very fast day trade or maybe an overnight trade. Be careful if you've got a pattern day trader. If you don't meet certain criteria, your broker limits the number of day trades you can do in a week. So make sure you're not going to go over that limit because otherwise your broker will slap a label on you and you'll have to start, doing a certain amount of trading and having a certain amount of money in your portfolio. But I'm looking at perhaps doing, a quick trade on the VIX, just trading it directionally on velocities. When the velocity hits a certain speed limit, I'm going to jump in. When it slows down, I'm going to jump back out. That's my main goal for today and maybe even Monday. But overall, yeah, I'm looking at the S&P. I'm trying to get an idea of how low do we go? Do we go below 5,235.48? Do we go below 5,133.59? We're already in sideways choppy territory, but do we go into trend reversal territory? Do we go into actual sell-off territory? I'm just looking for where the next bottom forms.
Awesome. And as always, the link to AJ's free daily workshop is in the chat. So if that's something that you haven't checked out, head on over there. Otherwise, show some love. Hit that like, hit that follow, hit that subscribe button. We do appreciate all the questions, everybody tuning in, the feedback. AJ, thank you today for your time. Thank you, everybody, for tuning in. With that, we'll catch everybody next week.
Take care, everybody.
For tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll